month of September, South Africans observe Heritage Day, which was on Sunday, this last week, the 24th. And obviously, the whole idea is that we recognize and celebrate the cultural wealth of our nation. So cultural heritage refers to all the cultural traits that exist in our society and are inherited from our past, whereas cultural inheritance refers to specific things that are inherited, such as our music and our dance styles, etc. So heritage is something that can be passed from one generation to the next, something that can be conserved or inherited, or something that is historical, cultural, or of cultural value. So inheritance is the term used to describe the assets passed down from one's immediate ancestors, in other words, from a father to his son, such as car and tools. Now, I'm one of those people that inherited tools and I don't know how to use them. So yeah, but what if you inherited a share portfolio from the state? What is your options? And that is the whole context of today's presentation. So on the other hand, leaving an inheritance for your children is good in that it helps them to get through life. It obviously eases their financial burden. It represents your love for them and care for them, and shows that you did well enough financially in life that you're able to leave something to your family. As I said, I inherited tools from my father, but I'm one of those guys that want to leave a better legacy for my children. Do you know that 70 to 80% of households never receive inheritance? So most of us are in that category. So this obviously the people that do receive inheritance, I presume will be a very small number, especially on this webinar. So the whole idea of today's webinar is I still want to make it applicable for you, even though if you might have received the inheritance, you might have existing share portfolio, you might be considering starting a share portfolio. Also, for those of you who are considering leaving a legacy. Okay, so here's the agenda for today. So there's my 3 parts always. Inheriting a share portfolio, so obviously I can talk to those people that do receive inheritance, and then I think mainly for everybody, portfolio management basics. And I know there are 1 or 2 financial advisors and wealth managers on this webinar. Okay, so yeah, so just to give you some context, here's a little story. Several years ago, a guy called John, his grandmother passed away and left him an inheritance of 200,000. So he quickly decided he wanted to buy a boat with that money. His wife Renee, on the other hand, said to him, "Whoa, don't you think we should talk about this first?" She said that that she can think of many things that you can do with 200,000. It quickly turned into a philosophical discussion as opposed to an argument, but how they think about money. So John felt that it was because the money came unexpectedly and was unearned, it was play money. Whereas Renee, on the other hand, she felt the money would give them opportunity to either pay off debt or contribute to their 2-year-old daughter's education fund. But ultimately, and it was a split decision, John bought his boat. So John inheritance is part of a larger societal trend. Okay, so you might have heard of the term great wealth transfer, which is happening right now. And do you know, right now, between now and the year 2045, okay, the baby boomer generation is expected to transfer more than $53 trillion worth of their wealth to their heirs. So that's why we talk about this great wealth transfer. But also, do you know that 55% of people say spending money now, okay, enjoying your money now to have more experiences is the better description of wealth, as opposed to the 45% who would rather sacrifice experiences now to save money for later. That's quite interesting. So we nearly got more than a 50% split on the whole idea of that. So what is considered a large inheritance in general? And this is some information I got from the internet. In general, a large inheritance is a sum of money or assets that is significantly larger than your typical annual income. So that's what we call a large inheritance. But saying that, for some individuals, a large inheritance might be 100,000, whilst for others might be several million. Okay. So the whole idea is that managing your investment portfolio will put you into control, number one. And number two, it also teaches you more about investing. And also, if you're a complete novice, like, I'll use an example now soon, you might inherit this portfolio and you're a complete a novice investor. You're not sure what to do. You know how to get started. Maybe you're wondering, is it a good idea? And hence this webinar. Okay, so let's get going to it. Inheriting a share portfolio. So the whole idea is when someone passes away, the executor of the deceased estate will go through a whole lot of complex stages before the bequeathed investments obviously becomes yours. The executor can, according to the will, obviously choose to either sell all or some of the shares owned by the deceased and pay the proceeds to the beneficiary, or they could transfer the ownership of the shares to the beneficiary. Okay, so I want to show you a practical example, and this is hence I had this idea for this presentation. Okay, here's an example of one of my clients. This is just a snapshot of her portfolio, but what happened is the father died. His portfolio was worth 8 million. Okay, 8 million rand, and the whole idea was, yeah, and 8 million rand, and that portfolio consisted of 86 different companies, 86 different shares. Okay, and the portfolio was split three ways. So his wife got 50%, was 4 million. His daughter got 25% or 2 million, and his son got the other 25%, which is also another 2 million. But all those 86 shares were split equally along those ratios. Okay, so that's what brought my whole idea to this. And once she phoned me and says, now, how do I do this? What must I do, etc. So we're going through this whole process of managing the portfolio for helping her make a decision. So my question was, is it too many shares, 86 companies? Is it too well diversified? It's like basically having a unit trust. There are also obviously some big losses on the portfolio. Do we keep them or sell them at these levels? Do we add a stop loss at these levels? So what is the story behind the shares? That was a big thing for me. What was the story? Why did the father buy these shares? And you can see in that little pie chart, those big pie slices, those are 4 different banks. You can see I've highlighted there, for example, ABG, which is the ABSA group. But there's ABSA, there's First Rand, there's Standard Bank, and what's the other one? Nedbank. So most of his portfolio was in banks. So I still have to ask her, was her father involved in the banking industry? But I would presume so, because he really loved the banks. But as I said, what was the story behind the shares? Why did the father have to buy those shares and things like that? So there's a story behind each one of those shares. What I felt sorry was that he never taught his family, his wife, about the shares. He never shared his love of investing and understanding about it. So the whole idea of today's presentation is just to create a greater legacy. If you've got a share portfolio, how do you create a greater legacy? And the way I look at it, a share portfolio is a gift that keeps on giving. That's the way to look at it. Okay, so the idea here is also, if you want to create a legacy, or if you want to start teaching your children, especially young children, share your portfolio with them. Obviously, make it relatable. Tell them why you bought these certain companies. Share the basics of compounding, the meaning of investing. You want your money to work for you. You've worked hard for your money. You want to get your money to work for you. You want to share the idea of encourage learning and doing research on companies. The idea is that you want to be a patient teacher, and that's the whole idea about this. And I'm sorry that I never had this with my father, but I want to teach this with my children. I am doing it at the moment. Okay, so that just gives you some insights and things like that. And by the way, those losses, you can take those realized losses and then offset them against the gains, so you can have capital losses. And there's various ways of doing it, but it just gives you some insight. Okay, so when it comes to inheriting a share portfolio, it is a mixed blessing in the sense that it is an emotional time. You're receiving this portfolio just after you've lost a loved one. It's difficult to think straight. There's a lot of conflicting emotions and things like that. On the one hand, you're sad and you must still be grieving, but also now you've got this financial windfall. Okay, but the whole idea is that you can do whatever you want with this portfolio. You got various options. Well, you got two basic options. Either you keep the portfolio or you sell it. I'm leaning towards staying invested. You adjust your portfolio. Say, for example, you got existing portfolio at PSG Wealth. Transfer those shares into your portfolio. The whole idea is that now is just you integrate it into your current portfolio, and you're still honoring the legacy that you've inherited. That's why I look at it. You also might be in the situation where you say, okay, I want to sell some of the shares. You want to sell all the investments. It's up to you. But the whole idea is I would lean more towards getting my money to work for me and honoring, as I say, honoring that legacy. Okay. So there's various do's and don'ts that comes with this. And the whole idea here is that, as I say, you're going to have conflicting emotions. You're going to be in a situation where the sudden windfall will create a challenge. You want to be able to manage money responsibly. As I say, you've got heightened emotions. So the idea is to create a list, or as I say, here's the list of do's and don'ts. The whole idea is that understand the nature of the gift that you are given. So yes, you got someone's legacy. This is what the share, the way I look at it is it's someone's legacy that you've inherited. Do the story behind it. But ideally, you want to be in a situation where you go sit down with a financial advisor. And as I said, there are quite a few on this webinar today. Sit down with a financial advisor, sit down with your attorney and things like that, and ask them to help you. That's all. Yeah, talk to professionals. Don't do this by yourself, especially in this time when there's a lot of heightened emotion. Okay, so I'm going to go through all these points here. I want to highlight that idea there. Allow yourself a bit of a splurge. You want to take, if you inherit R1 million, you want to go spend 500,000 Rand buying toys and things like that. Be a bit more conservative. Maybe 2% of that investment, so 10 to 20,000 Rand. And go buy something that's going to mean something to you. Don't be impulsive, and obviously don't quit your job immediately. Some of us might need a few million before we can stop our job immediately. So don't do anything impulsively. Okay, and the whole idea is to say, it's just a plan. Don't spend your money before planning. Okay. So portfolio management. I'll spend more time on this. Very important. What is a portfolio? A portfolio is just a collection of shares. Or in this context, there's also some things we need to understand. First of all, if you're inheriting a portfolio, you need to understand what is your risk profile. So yes, you want to be in a situation where you've inherited this portfolio, but you do not want to see the value dropping. I think no one wants to see that dropping, but there's no guarantees that it will not drop. That's the nature of the market. The market rises and it falls in value over time. So it's just being able to understand your risk tolerance. If you're very, very conservative, you want to conserve value, then you need to consider maybe we tend to feel emotional, and then we make some silly decisions when we are emotional, and it obviously makes a big impact on the portfolio. So the whole idea here is that you've been handed this portfolio. You need to assess each individual company, and if you've got any shares already, how does that affect asset allocation and diversity in your portfolio? And we'll go into that in more detail. Now, I'll go. One of my clients, regular clients, he inherited a share portfolio from his dad, which only considered one share, Remgrow. But he had bought Remgrow many years ago because he was working for the Remgrow group. But obviously he had over the years, the companies unbundled and things like that. Ultimately, he ended up 5 different companies, but it's still 20% concentration in each of those companies. That portfolio is very, very big. It consists of Richmonds and etc. Okay, so the whole idea here today, as I say, is to talk about. I'm going to talk about 5 principles. Number 1 is asset allocation. Before we get to asset allocation, we need to understand what is an asset? Robert Kiyosaki in the book Rich Dad Poor Dad says the asset is something that puts money in your pocket, whereas a liability takes money out of your pocket. So there's various asset classes, and obviously it just refers to a specific category of investments. So they share the same characteristics and qualities. So, for example, shares. I call it paper. Shares will be the same as unit trust, same as ETFs. So that's what I call paper, but it's still in the equity market. Obviously, within unit trust, you can still have exposure to the bond market and the cash equivalents and things like that. So you can break it down a bit further, but also it depends on other little factors. So things like your age, your risk profile and risk tolerance, your investment goals, and obviously the amount of capital that you have. So if you're inheriting a portfolio, it's already been decided for you. Okay, but the whole idea with a asset allocation is just a long-term mix of assets. So yes, you might inherit a share portfolio, but you might have other investments. You might have rental property. You might have physical Kruger rands and things like that. So those are all part of the asset mix. So the idea is that you want to put all this money together in both volatile and non-volatile assets, because what you lose on the swings, you make on the roundabouts and vice versa. Okay, so it helps. The main goal is obviously you want to have maximum growth with minimum risk. Okay, so that's what asset allocation is all about. It's just spreading that your funds around into all different asset classes for the best possible growth with minimum risk. Then we talk about diversification, and this is one of the most important principles you can use in any investment. So instead of putting all your eggs in one basket, which is never a good idea, again, you want to spread the risk. So within, for example, shares, we're talking about share portfolio today. You're not going to have all your money just in gold shares, for example. You're not going to have all your money in property, for example. And I know some people do have all their money just in listed property companies. Okay, but the idea is that you want to diversify across different shares, different sectors, and geographical. So yes, in this context, we're talking about a local share portfolio, but also you might have an offshore share portfolio, but you're still in shares. Just understand you are diversified geographically. That's the idea of the offshore portfolio. So the experts say you should cover between 3 and 5 different sectors. Some people go as high as 7. But the whole idea here, as I say, we'll talk about it in more detail just now, a sector balanced portfolio. The whole idea is to limit losses in declining sectors and offset that with profits from rising ones. Okay. So you also might go look at the quality. I always talk about quality. You might be, some part of your portfolio might be exposed to higher risk, or I call it the red chips, what you call fledgling or micro caps. These are smaller than small caps, so they're below small caps. You might have some money exposed to the smaller caps, so obviously a higher risk, but are also offering you higher returns. You might have some money exposed to large caps, which we call the top 40, and the next 60 companies after that we call the mid caps. Okay, so anything outside the top 100, we will call that small caps, and then below that will be the fledgling. Okay. There's also a danger that you might be over diversified. Going back to my example run beginning of 86 different companies, each share added to the portfolio lowers the expected return. Warren Buffett coined the phrase diversification. If you only got one share in your portfolio and that share drops, you got 100% chance of risk. You got 2 shares in your portfolio now, you got 50-50. 3 shares goes down to 66%. Oh, sorry, 33%, and so it goes on. Okay, so the idea here is that you want to bring that risk right down to a manageable stage, and depends on, and that's between 3 and 5 different sectors. That's when you want to spread your investment across, and I'd say maximum maybe 20 shares in your portfolio. Because you see, as I said just now, if you got 1 share, you got 100% risk. 2 shares, you got 50% risk. 3 shares, 33%. So it goes on. 4 shares, 25% risk that one company can bring a portfolio down. 5 shares, you got 20% risk. You go down to like 20 shares, now you're down to 5%. So that one company will hurt you only 5% of your portfolio. You go down to like 25%, you got 4% risk. 3 shares, you got 3.34%. 40 shares, you got 2.5. But now the challenge, as I say, the best way to avoid over diversification is to keep your portfolio at a manageable level. Because remember, you have to do research and analysis on all these different companies. So yeah, again, it's a personal thing. But important here is to spread the risk. Okay. Okay, let's talk about sector diversification. Do you know that on the JSE, there are 353 companies listed? 353. Okay, in the total, the JSE is broken down into 8 industries. You can see all there on the far left-hand side. Okay, 10 different industries, and within those 10 different industries, we have 19 what they call super subsectors. Okay, super sector. Sorry, there's a misspelling there. It should be a super sector, and within that, we'll have 41 sectors, and within those 41 sectors, we have 114 subsectors. So each sector obviously holds shares with similar characteristics. You can see there gas and oil materials, and that's broken down into chemicals. There's 55 companies in the basic material sector, and that's broken into 6 companies in the chemical sector, majority in the basic resources, which we will say is a majority of the stock market also. Okay, so it goes on. So the question I always say, if people always ask me, is that what are the best sectors to invest in? You know, if you can look at these different sectors now, you know, the basic material sector, very sensitive to economic conditions. Yeah, this is where we're talking about companies providing materials are going to making other materials, okay, other products. So that's mainly, as I say, your mining companies, etc. But these are guys have high volatility. If you're a conservative and moderate investor, be aware that this is high volatility, especially in tough economic times. The industrial sector, you can see it in boom times, they do very well. And obviously, when the economy starts tightening it, these companies suffer. Okay, consumer staples, and those of you that are a bit more like the more defensive stocks, this is where you want to be focusing on some of your shares. Number one, they're stable, and number two, they also offer high dividend yielding shares in the sector. So the whole idea here is these are companies that use household products. Okay, so it's a range from food to bathroom items to baby products. This is necessary for the normal function of any household. So again, when I highlight it for you, so you know, this is where you'll find your stable, high dividend yielding stocks. Look at the healthcare, also very defensive. Yeah, everybody, if you get sick, you still go to the doctor, and you still go to the chemist and things like that. Okay, so this is where you find the companies that develop the drugs and the hospitals, etc. The financial sector, very important, very big. Also very highly sensitive to economic conditions. Banks make profit when interest rates are rising, like we're seeing at the moment. Insurance companies also do very well in a high interest rate environment. I believe we're very close to the top of the cycle now with interest rates. We might stay higher for longer before we start seeing the market the interest rates coming off. And always remember, the interest rates in the stock market is like a seesaw. Interest rates come down, market goes up. Okay, so you want to position yourself for those companies going to benefit from lower interest rates. Okay, so and then technology. This is a sector that one of the most volatile sectors on the market. But if you're interested in growth stocks, companies growing faster than its peers, this is a sector that is the best place to look. Okay, that just gives you quick insight if you're looking at repositioning your portfolio and things like that. Okay, and then we talk about rebalancing a portfolio. So ideally, you want to rebalance a portfolio, especially right now. We've had a long bull market now. We're top of the market. You want to maybe reposition it. You want to do it usually once or twice a year. You want to turn it back to its original target allocation. We originally had 10 companies, and they were each allocated 10%, and some of them might have gone out at kilter, some of them might have doubled. Now that exposure is 20%. You might want to obviously realign that. So there are a lot of other factors that come into it, but the main thing there is the prevailing market movements. And other things is also your current financial situation. You might find, geez, interest rates are high. I'm paying a lot more on my bond. The money's tight. Let me take some of my money out of the market and settle some of the debt, etc. Okay, but the whole idea is you want to determine which shares are overweighted and which are underweighted. You might redirect some of that money to the ones that are underweighted. As I said, just other shares that are losing, those might be the capital losses that you can incorporate, as well obviously offsetting the capital gains. Okay. And then we talk about reinvesting those dividends. Another principle that I find very important. Obviously, some people have a share portfolio just for the capital growth. Not all companies pay out dividends, especially new companies. They want to reinvest back into the company for their growth. But it's always better that you reinvest the dividends than withdrawing the cash. Okay, because remember also you pay dividend withholding tax on any dividends you receive. So if you're reinvesting those dividends, especially back into buying more shares, especially with companies that have a dividend, what we call a dividend reinvestment plan, or DRIPs, it just makes your life so much easier, because remember, there's no brokerage on those kind of shares. Now, I want to highlight something for you. I'm in charge of corporate actions here in PSG. I send corporate actions to our clients. I'm amazed how many people do not have the correct email address with us. And then they miss out opportunities. So especially if there's a lot of companies that are paying out dividends, and you also have the option of receiving a scrip dividend. So the whole idea of this presentation in this slide is to take the scrip dividends rather than invest back into the shares, because it's future growth that you're getting there. So just another way of smart way of leveraging the power of compounding. Okay, well, your money makes you more money. There are also times where it makes better sense to take cash. Sometimes you might be close to retirement and you need the money. Rather take the cash out. After you pay your dividend withholding tax 20%, but you're still getting 80% after tax. The company might be not performing well, and they're paying out dividends just to try and keep their shareholders happy. Rather take the dividend and reinvesting it, especially if the company's future prospects don't look so rosy. You also might want to, take the cash instead of reinvesting into the company. You might be too exposed to that company already. You want to diversify into other shares, and then also, as I say, reinvesting it and balance your portfolio rather than investing to other companies. Okay, and then the last principle I want to talk about is just the long-term nature of being a long-term investor. Shares have historically delivered better returns compared to other asset classes over the long term. So the idea is the longer you can be in the market, you give you a chance for your portfolio to recover. Okay, so ideally you want to hold a share for at least a 3-year period, because after 3 years then capital gains tax applies, which is much lower rate than paying income tax. So the idea as a long-term investor, you need to be patient and you need to be disciplined. Okay. And then also, obviously, if I'm buying and holding and I never trade as much as people feel insecure. They feel they rather sell their shares and they buy back and they get the timing wrong, and they sell low and they buy high, and vice versa. Okay, so you don't want to be in that situation. Okay, cool. So we're going the wrong way. Oops. Okay. So how do you leave a growing portfolio to your children? What's important here, I think, is just leaving a legacy. That's what's important. So legacy is something that commemorates your life. Let's move this out the way here quickly. Sorry. Commemorate your life. A family legacy, on the other hand, is this providing financial security or passing on money to or property to your heirs. Okay, so we are talking about financial, estate planning. This is where you determine how your assets will be preserved, managed, and distributed after your death. Okay, so the main idea also of estate planning is obviously avoiding paying tax paying too much, because remember, with estate duty you pay 20%. You also got things like capital gains and donation tax. All that kind of things will have an impact on the actions you take while you're still alive. So that's why it's important to sit down with your financial advisor and do some estate planning if you are looking at leaving a share portfolio for your children. Ideally, you should consider creating a trust. yeah, we talk about obviously having growth assets, and our idea of the trust is also preserve and protect those assets for future generations. So some of you might be in a situation where it's too late to do it right now. So one of the better ways is to keep life insurance to pay for those taxes and things like that. That's another way of looking at it. Okay. And then you can also obviously bequeath 3.5 million to your trust. And obviously the whole idea there is that if your estate is worth less than 3.5 million, you do not pay any estate duty. So I've kept it very, very basic. Those of you that are interested in this, I sincerely recommend that you go talk to your financial advisor about estate planning. Okay. So just quickly before I hit the questions, to summarize, as I say, receiving an inheritance can make your life easier. Obviously, it also makes your financial decisions a bit more complicated. There was a list of do's and don'ts. The whole idea there is just don't get too emotional and not think straight. Just do some planning. And obviously, the idea is when you receive an inheritance, you have a choice, either sell it or keep it. My option would be obviously to keep it and to honor that legacy. We discussed the 5 principles of portfolio management, and then obviously leaving a legacy, leaving a estate. I'm also surprised how many people do not have a will. And if you don't have a will, it goes into what they call prostate. You don't want those kind of things. Just creates more agony and things like that. And then obviously we spoke about a trust. Okay. So guys, from my side, I hope you've enjoyed this presentation. Obviously, we spoke mainly about shares today. I've touched, you can look at offshore trading accounts also as an inheritance. There on that side, I'll look at more ETFs, a bit more specialized knowledge for offshore. Okay, so let me see what kind of questions we have. Maximizers. Wow. Ewald, long question, yeah. Okay. My children, this is a question from Ewald Pretorius. My children and grandchildren are living overseas, Switzerland and Australia, and are not tax residents in South Africa, financial immigration. How will their portion of inheritance work? From proceeds of a living annuity, as well as a shared. Ewald, I'm not 100% sure. I'll have to get back to you on that one. I have to do some research, speak to some financial advisors. Okay. What taxation is applied? Is a question from a vessel. What taxation is applied on the inheritance in a share portfolio? Only inheritance tax when applicable, or tax on profits from existing portfolios to be paid out of the state. So obviously, when you inherited a share portfolio and things like that, the executive would have settled any estate duties and things like that, and paid any of those costs. But vessel, that's mainly things like that. So you've got existing portfolio, you have to look at going forward, what kind of taxes will be applicable to you. Again, speak to your financial advisor. Do you pay estate tax on cost value or market value of the portfolio? So obviously when you have a share portfolio, you'll have a cost value when you bought it, and when you sell it, whatever the difference is, that's the capital gains you pay on it. Okay, estate duty, I'm not 100% sure what it'd be the value of the portfolio, the existing value, Mohammed. I'm not a tax advisor, people. Please understand it. I'm not giving any tax advice here either. So please refer back to your financial advisor. Okay. Here's a question from Sunette. How can I contact a financial advisor that can help me with fiduciary planning? Good question. If you go into our homepage, please use our homepage. There's a little button along the top called Find an Advisor. There you've got an option to search for product. And within that search for product, you'll be able to search for wealth fiduciary planning. Just click on it. And then from there, you obviously look for the location and find the closest office to you. So Sunette, I hope that answers your question. Here's a question from Temba. I don't have the time or experience to manage my own share portfolio. How can I get a wealth manager to take it over? Good question also, Timber. Well, first of all, it depends on the size of the portfolio. Most of these financial advisors won't take on anything less than 100,000 for a local share portfolio, anything less than 2 million offshore. Reason for that is because of lack of or flexibility. Remember, they also want to manage risk, so they want to have a diversified portfolio. Yeah. So how much do you have, Timber? Okay. Small portfolio, less than 100,000. Timber, so that the most financial advisors won't take on a portfolio of 100,000. I would suggest either learn to do it yourself or move your shares into ETFs. Alternatively, drastically, maybe sell everything. Hopefully, it's not too many capital gains. Your first 40,000 is tax free anyway. Cash out and maybe move it into a more tax efficient vehicle like a RA. And then, yeah, that's how I suggest to do it. So, Tema, yeah, difficult one, I know that some financial advisors will take on clients and create what they call a PSP, a private share portfolio, which is very, very, what they call a tax efficient vehicle. You might want to structure your portfolio within a trust. And obviously, the whole idea there is for asset protection. I know the PSP works something like an endowment wrapper. So it's very, as I say, tax efficient. Okay. Vessel, thanks. Tax advisor, Sean. Vessel, I'm not a tax advisor. Please understand that. I'm not sure 100% what you want. You got the same story with Jordan. Glenn, can you send info where my children live overseas? Okay. Okay, Morgan, yes, the presentation is recorded, and I will be sending it out hopefully in a day or so with the PDF. Okay, pleasure, Glenn. Okay, thanks, Morgan. Cool. Okay, so guys, from my side, as I say, I hope you benefit from it. If you got any questions, drop me an email, wealth@PSG. You can also call me on the OneStream line, 0860-000-368. From my side, this is my last thing as a disclaimer. Everything I did in this presentation was not for soliciting any investments. The whole idea is for education purposes only. I'm not a tax advisor. Remember, it is all for tax. I suggest you go consider, go talk to your financial advisor, your tax consultant about all these things. I'll get back to the questions you guys asked. But from my side, thank you very much. Until next month, bye for now.